Hi, friends. Welcome to the webinar. Sorry to keep you waiting for a couple of minutes. Let me know where you're from in the chat box. And if this is your first time, and we are good to go and ready to rock and roll. So I'm going to share my screen with you. I've been working for the last few hours on a completely new bunch of slides, as well as giving you a market update. So let's get on with it straight away. You'll want a comfortable chair, you'll want a glass of water, and you will want a camera phone so you can take pictures of some of the things I'm going to show you, because they're going to be on and off the screen relatively quickly, because we have a heck of a lot to cover over here. If you see me looking off camera, it is because I've got various things on screen. One of the many things I will cover, as well as UK stocks, is I'll also go into what you can see over there, the S&P, where we think we're going this year, which securities I like the look of. I will also, so you do not feel left out, will also cover the FTSE 100 or the UK markets as well, and why there's nothing in there that I particularly like at the moment, and I'll explain that. So for those who are my clients who are having a heart attack saying, why are you showing the holy grail of the information? Actually, I'm going to show you why on the FTSE 100 there's nothing at the moment that I particularly like. It's being outcompeted by other companies likely to give greater return with lower risk. So I'm going to go through all of that as well. We've got New York, Chumley, fantastic. Cleckheaton, well, I went to school in Fulneck, so Cleckheaton is not far. Looking good. East Sussex. Bonjour from Angers. Is that Angers Marguerite? Hello, bonjour. So, right, first things first, I will come back to both of those major topics. But one of the first things I want to do, I've got so many screens open, let's close all of that as well. One of the first things I want to do is take you through the macroeconomic side of things. There's only two things which matter at the moment. I can cover them very quickly with the stock market. One is interest rates. If the interest rate cycle around the world, including the UK and the US, bottoms out, in other words, they're going to stop reducing rates, and they just had an interest rate cut in the US, then it's likely to be bad for stocks. Not least because technology stocks will end up having to, with their debt, have to pay more in interest charges. Consumers will have to pay more, and government borrowing becomes more expensive. Okay, all governed by the rate of interest. And therefore, stocks fall because they become less profitable, because consumers are spending less, government spending less. So therefore, companies are making less profits, stock prices fall. We don't have an indication yet that the interest rate loosening cycle has come to an end. Okay, that's what we're looking for. In 2022, when the indication was it's come to an end, and in 2018, markets declined significantly, 25%, over a long period of time. So when people talk about crash, they talk about amount, not duration. I don't think there'd be a crash. The duration, 12 months to lose 25%, well, actually it was 7 months to lose 25%, isn't a crash, because crash would imply happens within a week or a month. So let's get rid of the crash talk, but markets can decline. Okay, every 5 to 7 years, they do, and it feels like a crash. Even a small fall feels panic stations. The main thing to look at is, are interest rates coming to a close? Today, they're not. Now, all the indications we have, they're not. That could change tomorrow morning, but at the moment, they're not, and therefore you don't need to take a decision to panic or prematurely exit. Okay, that's the first point. The second point I want to make to you is AI. That's the other talk of the town. So at the moment, the markets are looking for excuses to take some profits, year-end bonuses. And one of the excuses they're looking for is, are profits decreasing? Now, profits and sales are not decreasing generally for AI-related companies and businesses. So the next thing they're looking for is, but is there slowing down? Even if they're not going into a loss, they're making profits. Is there a slowdown in the rate? So can you imagine, you're reading between the lines. It's not have interest rates fallen or are they likely to fall, but is the cycle finishing? It's sort of not one step ahead, it's 3 steps ahead. Similarly with AI, it's not about profitability because we know they're profitable. It is, are they likely to slow down in their profitability? Now, again, at the moment, if any company is like that, they're getting slammed. Oracle, and I'll show that in a second. But generally, that's not a structural problem with the companies. It is noise. It is panic on an individual company basis. If it happened across the board, like in dot-com bubble, then yes, there'd be a reason to worry. We don't have that yet. Will it come in the future? Probably, possibly. When? I don't know. So the bottom line is, at the moment, I'm still filling my boots. What does that mean? Well, it means I'm riding the tide. It's fine. I'm not panicking. I don't panic about things which might happen in 3 years. Will there be another stock market crash? Guaranteed. When? Sometime in the next 100 years. Well, that's not much bloody use, is it? That's my point. So therefore, today, don't need to worry, and that's fine. So I'm invested, and we'll go through some of it in detail. When I look through everything else that I could think of, which might impact the markets, well, there isn't. War from Russia, it's not impacting it. Oil price is still below $80, so irrelevant. Gold going up, well, that doesn't impact the stock market directly or doesn't of any particular weight. China-Taiwan conflict, benign, no issues. Trump tariffs, markets making all-time highs. Silver's all-time high, gold's at all-time high, stocks in the UK and US are at all-time highs. So the warning signs I'm looking for, are any signs that the interest rate cycle is slowing down and AI spend going into reverse gear. Neither of those at the moment are happening. Now, everything else are boring, dull headlines. They are panic station headlines. Let me take you through some of these because it's incredibly important that I do. Okay, on this. Now, what will happen is you will see, and so you know how to read the news items on these things. You will often see red. I was at Bloomberg 2 days ago. Some Oracle data centers for OpenAI delayed to 2028 from 2027. Okay. My God, that sounds really scary. Oh my Lord, what is going to happen? That is not a BlackBerry moment for Oracle or any other company. That is, there's a bit of delay. They still want your product, but there's a delay. Now, if you're a trader, you might say, right, short Oracle, go long something else, right? But you're not a trader. Don't try and be a trader if you are an investor. Got it? So we're going to change your mindset as well on these things. And that's going to be critically important. By the way, one of the very important places, in case you're not on here with me, is my Telegram channel. Let me know if you don't know about it already, because I'm going to be telling people on now, www.alpeshpatel.com. This is also where all my webinars will always appear. alpeshpatel.com, ladies shares. All you have to remember is alpeshpatel.com. We're consolidating all our sites so they're all in one place. I'm just letting everybody know on Telegram, you better come along. So, data set. There's not a panic to be had. When I was doing my TV show on Bloomberg, of course we were interested in headlines. NASDAQ 100 drops 1.6% as 30-year yields jump. So we created a little algorithm to look for words like slump, dump, jumps, okay? Slump, jump, dump. They generally, finance people aren't particularly clever. So, and the idea was that there'd be this over-exuberance. 1.6% on the NASDAQ is just noise. But it's there. These headlines are there to make sure you click. If you don't click, see those adverts? They don't earn any money. So most of the time as an investor, your job is to sit back and not actually do anything. Okay? Look at that. Prediction markets turned the world into a casino. My God, the stock market got there beforehand. So when you look through these news items, I like reading them. But 99.9% of the time, there's no action to be taken unless the company has done a BlackBerry moment. How do you tell it's becoming a BlackBerry? It's bloody difficult, except in the rearview mirror until it's too late. So you should look at the portfolio, not the individual stock. You will get stocks which looked great but don't perform. Don't let that worry you because they're one of a team of 20 to 40 companies. So we're going to cover that as well. Stocks to watch when Supreme Court rules on Trump's tariffs. Now, that could be a biggie, but not because it's going to ruin businesses. It's going to be short-term noise. Okay? rotate. Whenever you hear the word rotate out of one sector or another, it is for brokers and news journalists to get you excited to move. Because when you move money, just like the tax man knows very well, or the government knows, you get taxed or there's commissions to be earned for somebody else. So these rotations, are they permanent? Clearly not. Do you think everybody's rotating? It is today's news, tomorrow's fish and chip shop wrapper. Okay, so see that? Fed set up to keep cutting rates in 2026. That's interesting. That's good for stocks. Still nothing for me to do. Bitcoin dips below $90,000. Until it gets to 50, I'm not interested. Most of the time, the reason finance is the easiest work, or investing is the easiest business in the world to do, is because you don't have to do anything. See that story? Why it's harder to tell gambling from investing nowadays? Because of all that noise. Clouded as news, right? So most of the time, I'm going to be telling you to do nothing. Now, I would do a lot better saying to you, you must watch this to do this, do this, do this. We'll talk about what I have and so on. My contact details. I don't think I've shown pictures of my team in Switzerland before. A rather attractive bunch of individuals. So we have a private equity fund, which is born out of my main company, which was out of the UK. It still is out of the UK, at Brook Street. That's our Brook Street offices. I wish I owned the whole building. We have one room as our office, and it's rented. In case people think, my God, that's gorgeous. I wish I owned it in Mayfair. So that company is still there. That's where we set up the equity long short fund. We've now also got Zurich Frolichstrasse, if you know it. And then I do work with, that's my team that I work with on some of the government work that I do, which you might know. Okay. So you've got contact details. There you go. And you can email. Now, here's something else. Before we dive deep into which stocks I like, which I don't, and why most of you would mess it up, even if I tell you a company which is going to go up 50% in a year. And I'll tell you how I know most of you would mess it up is because I'm just going to keep an eye on things here over here, right? Let me just show you a classic example I teach people with. Okay, you go back to 2021. Right, 2021, and you look at Microsoft. And Microsoft in 2021 roughly went up during the course of that year, if we go right to the end of the year, about 54%, okay? During the course of that, give or take a percentage. And people look at that and they say, wow, Alpesh, that's amazing. You must have had lots of people, because they know I'm a long-term holder of Microsoft. You must have had a lot of people who followed you. Your family must love you and all the rest, blah, blah, blah. And I say, well, no, because most people would have either panicked or got bored. Write those two words down, panic and boredom. Okay, see that? That's an 8%, 9% drop. That was a 6% drop. This one is another 7.5% drop. So if those things, oh, no, we had another one over here from the peak to that's a 9% drop. So 4 times within a year, you had drops which were over 5%, which when they happen, a lot of people tend to panic. And you might think, well, I wouldn't have done that, Alpesh. Well, no, it gets worse. Because in actual fact, what happened during prolonged periods is you had, 3 months of 0% returns. Wasn't the only time. You had prolonged periods there. Throw that in another 2 months of absolutely nothing. I'm going to give you another one as well, which I show people, which I think this one, I don't think I did that one. Okay, so that's 2 months there of nothing. That's more, isn't it? That's 3 months of nothing, and there was another 2 months there. Basically, 9 out of 12 months, you got nothing in a year where the company generated 54% and you had to do nothing except not panic and not get bored. What would you have done? What would 99% of people have done? Why do CFD and spread betting firms do so well? Why do brokers make so much commission? Because 99% of people would have panicked and got bored at some point. And that's an easy example. Okay, it's a brain dead example of just buy and leave it alone, for God's sake. So I'll come to more of those points a little bit later on. Much of Apple's departing talent has flowed to Meta. There is a monopoly of talent amongst the AI companies. They have a monopoly on talent. They have a monopoly on profits. They can bankrupt any competitor or they can acquire them. Now, because of that, and I'm only stating the obvious, what if you think about it for a minute will make sense to you. For that reason, I'm not going to gamble and bet on Apple or Meta or Microsoft. Or for that matter, as you publicly know, I own Meta, Microsoft, Apple, Amazon, Alphabet, NVIDIA. What I'm going to do instead is own all of them. Because I'm not going to gamble on any one of them. Because Jeff Williams doesn't go and fricking call me up before he's leaving. Neither did Alan Dye or Lisa Jackson, if they make a difference anyway. So stop overthinking it. Think portfolio, not individual stocks. Are we in a bubble, therefore? Take a picture of this if you wish. The arguments that there is a bubble are, well, the 10 largest companies are 25% of the entire global public equity market. The 10 largest American companies represent 25% of the entire global public equity market. What that tells me is I think I want to own those 10 monopolies who are bullying everybody else into bankruptcy. What that tells other people foolishly is, I think I better look for some tiny little Vietnamese company. It's incredible how two people can look at things differently. Those 10 largest US companies are not going to get broken up. Hedge funds are going to continue holding them. So are retail clients or exchange traded funds for now. So I better have some holding of them. But no, Alpesh, that's not enough for me. I want more than they can deliver. Fine, let's do a leverage version of them, which I'll show you later on. But I'd only do 2 times leverage in my pension or my son's junior ISA. Valuations are stretched, Alpesh. Well, valuations are not the only thing that moves stock prices. Revenue growth is incredibly important, and they're not stretched compared to what would be in a bubble. Oh, but AI investment is surging. The capital expenditure can't possibly continue. What happens when one company is spending billions? That's more money than the federal government was giving out in furlough. What does it do? It sustains other businesses and raises the overall economy. What they're doing is they're inflationary. Imagine you got tax breaks into an economy of 432 billion. Okay. You'd start, and by the way, that's 10% of the entire size of the British economy. 10% of the UK economy is just the capital expenditure by a few American companies. So what that is saying to me, I better have some exposure to it. Whereas your typical IFA wealth manager, God forbid, St. James's Place numpty will say to you, looks a bit dangerous to us. Better just shove it somewhere completely different to all of that. And so we look at what Bill Gates, and I'll show you in a second, and Warren Buffett owns, and we think, they became the richest men in the world for a reason. But we want to manage that risk, which is what I'll tell you and how to do it in a second, because obviously we don't want to take ridiculous levels of risk. We're talking 10 of the largest companies in the world. We're not talking penny stocks. We're not talking newsletters breathlessly saying, put all your money in this. Look, I'm up 5 million% this week. That's fine. If you want to go to Vegas, I can be up 5 million% in Vegas by putting it on black. Anyway. Valuations are actually below past bubble peaks. Now, I don't care whether we're at a bubble or not. Obviously, I'd prefer it wasn't, but I don't care in the sense that I'm not a stockbroker. I'm not trying to sell you a retail fund. Okay, if the market was looking bad, and I'll show you my impression of it in a second, then the market's looking bad, and I'll tell you the market's looking bad. Let's get the hell out of it. Okay, but it's not. In that regard, and it's looking stretched. It's looking, I've got better be cautious, but this is what's happening. Strong balance sheets, free cash flow, which is what's funding capital expenditure, and there's real profits behind it. Okay, these are very important things. They're very important things to think about and to worry about as well. Okay, I'm just going to let people know elsewhere that we're on. So feel free to take a picture of that as well. Right. And let's go into this. Now, this is another question I get asked. What about emerging markets? Let's look outside of tech. Okay, let's look at emerging markets. Let's take an example. China, India, Brazil, and Vietnam. Let's have a look at some of those. Amazon pledges massive 35 billion into India. So Amazon is my emerging or developing market play. Because the alternative is You either go into an index tracker for India, which I'm going to show you in a second. Okay, and what the problem with that is, let's have a look at it. So take emerging markets. So this is the same applies to Brazil, Vietnam, or whatever. Okay, so let's take India. Okay, now the problem I have with that, and I don't have a problem with India, and take China or Brazil, okay, is this. When you project forward the rate of growth, and I've taken a little bit lower than it's done a couple of historic times, you're only getting 14% in a year, which is well below the kind of returns I want. And you might say, yeah, but Alpesh, you're only getting a lower return because you've got less volatility. Really? Because that's down 18%. Hello, that's the S&P 500. And that's down 25%. Okay? So for me, the countrywide one is too large. Okay, in that case, what about companies then? Well, the only companies I wouldn't want the ones listed in India, because I'd have to have rupees, or in China. So what I'd end up with is I'd say, well, which is a good prospect compared to, in the case of China, a China index? Well, I'd rather go into an Alibaba, which incidentally I don't want, not because there's anything wrong with it. I don't have any doubt that it'll continue going higher. It's that I don't like the volatility, the ride. It's the same reason I don't have Tesla. I know Tesla will go up and I know Oracle will go up. I just don't like the volatility. And it's okay not to like the volatility because there's plenty more fish in the sea. Can you see why I don't want that one as a proxy for China? So I don't want the index of the country because I can get better returns elsewhere. I don't want the individual proxy stocks because of the volatility. Okay? The same applies to Vietnam, which looks bloody atrocious. Anyway, so you might say, well, surely there must be another way. Maybe, Alpesh, what you can do is go out there and get a smaller company rather than some of these big ones as a proxy. This is my father's company. This is the company my father set up, okay, in India, Ishan Dyes. Now, I'm not suggesting you buy this. It would be illegal for me to suggest it in any event. And how's it done so far this year? It's gone from 53 to 67 since the start of the year. It's actually gone from, 38 to 67. Do not buy that stock. And this is not reverse psychology. He floated this in, 1993? I was a director when he first floated it. Don't buy the company because, first of all, you'd have to open a rupee account. God knows how you get the money back into sterling anyway. Let's say you could do all of that. These are small, relatively illiquid stocks. They're not sloshing around like an Amazon. So between the two, I mean, we've got family exposure to it, but let's say we didn't. I'd rather not have a small local company in Vietnam, China, or India. And this is from a bloke who knows these companies directly, personally. This is not some guy speaking to you from a distant place saying, well, I know a little bit about it. Let's go for this company, that. No, I've got skin in the game. And I'm saying I wouldn't own it. I'd rather have my Goldman Sachs or whatever else. And I'll tell you why. The competition that I'm facing, I don't want small illiquid companies in my son's pension. The competition I'm spending, and I'll show you, I'm having to deal with is, so, oops, it's right already on screen, is this. It's either that or that. And I've got this. Earlier this year, as some of you might know, I met Kunal Shah, the co-chief executive of Goldman Sachs International. Impressive guy, incredibly impressive guy. And I forgot to tell him I'm a shareholder in Goldman Sachs. Goldman Sachs has gone up over 50% in the last 12 months. That's more, that's almost double NVIDIA. If I had to put a bet, which is going to go up more, NVIDIA or Goldman Sachs 12 months ago, I would have said NVIDIA. Think portfolio level, not stock level. Don't get upset that, oh, my NVIDIA only went up 25% and Goldman's is up 50. Missed out. No, I had both. I wish in hindsight I'd put all my money in bloody Goldman's and leveraged it 10 to 1. I'd be up 500%. Why didn't you do it if you're so clever, Alpesh? The obvious conclusion being I'm not that clever. So that's how I'm going to get exposure to emerging markets. And the reason I mention it is because people mention emerging markets and getting out of whichever markets, in the big names. Microsoft invests $17.5 billion in India. Well, surely there's another way of getting exposure. I wish there was. If you know it, let me know. I don't want to go into my dad's company, which will surely benefit from all of this because I think it's too volatile and illiquid. I don't want the country level exchange traded fund, and I don't want the US listed companies from those countries because they're more volatile than the other alternatives that I have. So I'd rather stick to the traditional process of, is it all green? Is it all green on this? And that's why UK companies often don't make the cut. It's not because I'm racist against British companies or against Indian or Chinese or Vietnamese or whatever. It's if they don't make the cut, and none of these do for me, then they don't make the cut. And you must be bloody minded so you can go out and smell the roses. By the way, you can read this in your own time. I received this from somebody. One of the reasons why I love doing the weekly updates, webinars, but I'm going to continue doing on TikTok and YouTube, the daily market updates, is this message right there. That was reason enough. And I just thought, this is fantastic. I love this. I went to an AJ Bell seminar in London yesterday, and I learned more from your post on the train home than I did in the day with them. I'm not really surprised. They don't know. Well, just ask them if the people speaking to you have written 18 books on investing, which have become international bestsellers, reviewed on the back cover by Shares Magazine, Financial Times, Bloomberg, and multi-billion-dollar hedge fund managers. I'm not blowing my own trumpet, horn, call it what you will. It's to say, don't waste your time with listening to brokers. I've been very lucky with the invites this year in Parliament. Just as an aside, I'd like you all, because today's the anniversary, the 200th anniversary. Look up that name in your own time, Dadabhai Naoroji, a former British MP. Now, let's get back to all of this. World's data centers, where are they? They're in the US. I'm not being racist against other countries if their stocks don't come up. It's that if somebody's got a bloody monopoly and the biggest gun and the biggest firepower, and then their stocks come up as the most profitable, because they're bankrupting everybody else and outcompeting them by outspending and outgunning them, okay, and I happen to own a load of those, I'm not going to make an apology for it and say, well, I'm going to get rid of those because I better have some Russian companies or Norwegian companies or Malaysian ones. No. Where's your evidence for that? Okay, let alone the data that we have. Okay, so sharing a poll, will FTSE be higher? Well, basically from today's levels by the end of the month. 56% said yes. I better change that poll into will it be, will 2026 it be higher? I'll do that at some point. Okay, that's where the data centers are. Now, that's not to say the UAE might not have more eventually. They got 58. But how are you getting exposure to those countries? It's bloody difficult. By the way, which countries hold the most gold? So for those of you interested in gold, and just as an aside, the most I think you should ever have in your portfolio is 5%. If you're Indian, you don't even have it in your portfolio because your mum has got some already kept from a young age, or your grandma. Okay, and it's usually the grandmas and the mums, not the dads and the grandpas. So I was talking to a refiner, and he said to me, it's the Chinese buying it. And then I came across this. So the issue then is, oh, well, fine, that's simple. Then let's just do gold leveraged bets. No, we're not here to trade. We're here to invest, which means longer time frame, and the most you'd have is 5%. It's what I've written about in my Financial Times columns as well in the past. So what's my bottom line for 2026? We're not finished. Don't worry, we've got loads to do yet. It's this. My do's are these. Only stocks I would want to buy more of if they fall, because there will be falls. If you miss not just your profits expectations that the market had, but if you say we've exceeded the profits, but we think it's slowing down in future, for those of you who remember your calculus, it's the rate of change, not just the speed we're looking at. We're looking at acceleration, deceleration, not just velocity. Okay, then what that means is that those companies who might be slowing down will get really punished. So I only want the kind of companies which, if they're going to get punished in the short term, it benefits me, not that it punishes me. So if, for argument's sake, I owned Oracle, for argument's sake, and it falls 33%, I want the kind of company where I think, well, that's overdone because the business still exists. I'll buy more. Not, oh my God, I just got punished because I took a punt on Oracle and it's dropped 33%. If you've got the gambling mindset, you're going to get burnt, which is what 99% of retail clients have. And it's what brokers want to feed into, and journalists do, because they need you to click on their articles, and so do newsletter sellers. The only person who doesn't is Warren Buffett. He's too rich to care. Okay. But he'll say to you, no, I want the kind of companies which when they fall, I want more of. I want a quieter life. I don't want the type which when they fall, I think to myself, oh, crap, I just got screwed. Okay? Don't do what the IFAs will make you do this year, which is they'll make you chase trends. They'll say, oh, well, AI, but there's quantum, and don't do too much of the AI. They're absolutely idiots because they're trying to chase headlines and narratives. They want you to overtrade. Don't do it. They want you to rely on fund managers. And I'll tell you in a second why you don't want to be doing that. Tech AI exposure I will continue to have, not because of the narrative and the label, but because of profit and loss. They're profitable. They've got big fat balance sheets, which means they've taken those profits and they've put it into a bank account. That's their balance sheet. And they've got cash flow, which means they keep selling their stuff. It's got nothing to do with narratives of this happen. If there happen to be AI, so be it. Every company's bloody AI now, or it's dead. You know, I can look at, there's a little parlor game you can do at Christmas. Go look up a company and see in the field you'd think there's no chance that's got any AI. And you discover it's got AI. That's your game at Christmas lunch, okay? I'll give you an example. Here's a one to start off with. Chipotle. That's a bloody AI company, okay? Resilient companies, that's what I'm looking for in this kind of overbought market where there's more and more opportunity to scare people, okay? Play the company, not the narrative. Play the company, not the story, not the theme, if you want to avoid disaster. So in the case of Oracle, is the company still sound? Not the story. Oh my God, it's dumped loads, etc., etc. Don't overweight specific countries. Think company, not country. Think company, not country. Think portfolio, not stock. So as I've already showed you, that should say China ETF, not EFF. Okay. And if you really wanted China exposure, then I'd prefer an Alibaba to anything else. Remember, funds institutionally set up for failure. The Nobel Prize winner said this. When you go to fund managers through a St. James's Place or Fisher Investments who are advertising like mental, they're set up to fail and underperform. And I'll show you in a second why Eugene Fama got the Nobel Prize in economics for showing this. And the reason is too many stocks are owned by them. So they'll have 100 companies because they've got too much money, because they're massive marketing agencies. When I see Fisher Investments advertising on TV, I think to myself, you're going to collect so much money from people who don't know any better that you're going to have to buy more and more companies and put tiny amounts of money into them, i.e. what we call spray and pray. Or two, they're going to pick from a small pool of stocks because they've got a UK fund, a European fund, an Australian fund, an emerging markets fund, a growth fund, a value fund, a blah, 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 because that's business. They can sell you more shit then. Okay, so statistically, it's very difficult to win because you're picking from a small group. You know, I'm only picking World Cup winners for the England team from Watford players. Okay. 3, they can't go into cash when the markets fall. And that's a real problem because they're not allowed by their mandates. They can't charge you for holding cash. So when you get a period like this, which destroyed Scottish Mortgage Investment Company, if you remember it, a lot of people with their pensions in Scottish Mortgage, you know, when Scottish Mortgage was owning Meta and saying, oh, aren't we clever? We own Meta. Well, no, every idiot on the planet had Meta. But what Scottish Mortgage couldn't do is when Meta fell, okay, in 2022, 67% in 1 year alone, and overall about 75%, they couldn't just hold cash. They could sell an individual stock, but all the stocks are falling. You can hold cash, like we said to our clients in 2022. In January, we said, let's just wait till February. Let's wait till May. Let's wait till February to May. Let's wait till March to April to May. And I'll tell you why in a second. We didn't know that the whole year would be down. And the reason that's important is people like Scottish Mortgage and Fundsmith drag you down. Fundsmith, I think, for the last 5 years is generating about 5 to 6% per annum. Which is pretty bloody appalling, but they're collecting fees. And that fall, right, you might say, well, no, the IFA told me just hold on. And look, he proved to me, if you hold on, it comes back. Great. In 2 years, you got 0%. What if instead you exited because, as we said to our clients, let's just wait another month because the short-term prices are falling below the long-term prices. And whenever that happens, like green below blue, whenever that happens, it suggests you might want to wait a month. Then you waited another month because it was still happening until that flattened and started rising in January 2023. The benefit of that is you were able to have dry powder. We never pick tops and bottoms. We don't have a time bloody machine. Okay. So you got 146%, whereas they got 0. Look at my YouTube channels. This is an extreme example, which is why I like to give it, and a very popular one, which is I like to give it. That's why fund managers underperform. That reason as well. Okay, because when everything falls as it does in those markets and you need them the most, they can't give you diversification because everything is falling. It gets correlated to the downside and they can't go into cash. The only way to remove stock market risk is not to be in the stock market in times like that. They can't do that. And you could call up your IFA and say, hey, get me into cash, but you're not likely to because you didn't know that rule about small and medium, short-term and medium-term prices. So what happens? You trust the expert. Stop trusting bloody experts. Okay. Think for yourself. Everything I'm going to tell you, don't trust me for it. Think for yourself, saying, does that make sense? Oh, yeah. You just show me how it makes sense. Okay. So that's the third problem. And don't try to prematurely gamble on forecasts. So don't say there's going to be a crash in 15 years. I'll exit today. Think portfolio, not stock. So let's go into some of this. The problem we're trying to solve is this. The problem with fund manager experts like Neil Woodford, who in that Financial Times competition, I famously beat most of the competition on Bloomberg and Channel 4 that I've won. You too should not trust these fund manager experts. Don't take my word for it. Independently verify. Look at Eugene Fama and why he got the Nobel Prize in economics. Number 2, there's a problem with fund managers. Again, Financial Times article, amongst many others. I've written about it in my FT column. The active managers underperform simple benchmarks. And I'll tell you exactly why. Beyond the reasons I've already explained to you why they underperform, they take the benchmark they've been set and they say, right, it's got these 100 companies in it. Let's buy a bit more of British Aerospace and a bit less of Rolls-Royce. Then we'll outperform the benchmark. So they're trying to beat a benchmark. If they get that gamble wrong on more BA and less Rolls-Royce, and I already told you, I didn't try and gamble more on Goldman Sachs, less on NVIDIA. I bought both of them. They can't do that because they're trying to beat a benchmark. I'm not. I'm just trying to get an absolute positive return, which is what I suggest you should do. And the whole industry is built on benchmarks, not absolute positive returns. So you're screwed. That's the second reason why you've got a problem with fund managers. Third reason, high fees, poor value. St. James's Place, that's the Sunday Times article. Thirdly, and you can't quite see into there, but what that article says, I'm going to try and zoom in if I can. See if we can zoom in. Can you see it? UBS rich clients get Goldman PIMCO strategies with no extra fee. I don't know. Are you a Goldman Sachs client? Are you a UBS client? I'm assuming not. If not, why the hell shouldn't you have those strategies? My job is to make sure, like a little Robin Hood, I grew up in Armley in Leeds. Okay. So one of the poorest parts of Leeds, like a little Robin Hood, is steal that knowledge from the rich and pass it on to others. Why? Well, I have to do it through webinars because people have stopped reading bloody books. You can download a free copy of that. Just go to alpeshpatel.com. And then there's the problem with inaction. You're confused. So my job is to clarify things. More than £1 trillion of Muppet money costing savers billions. It's an article in City AM about exactly that point. That then you get confused. You don't do anything. That's the problems I'm trying to solve. Okay. So here are the people that I'm speaking to today. You are going to be one of these 6 groups. You're either frustrated with your pension growth. You might be a late starter and thinking, I need to catch up. You're an independent thinker thinking, I'm not going to freaking give it to fund managers. I want to do it myself. Legacy builder, i.e. you've sold a business. You're thinking about your children or your grandchildren. Professional, dentist, whatever it is, lawyer, not enough time to manage it yourself, so you need a simple way of doing it. Or you're just a smart DIY investor who needs a proper process. That's the groups. You're one of those. That's it. It's as simple as that. You're one of those. How we do it, as I've shown you, and I'm going to show you now, very simple. We go through 10,000 companies, European, UK, US, whoever's the best can enter our portfolio, and then we create portfolios. How do we create portfolios for my son? And I'll talk about some of the stocks he's got, or for my wife. Whoops. This. See that number? That's what people neglect. That I can't guarantee will ever happen again. As I tell my wife, I can't guarantee we're going to keep getting 30% per annum. It's just been a bloody amazing 2021, 2023, 2024. Okay. And 2025. That's not out of my hands. I didn't know it was going to be that amazing. Nobody did. So I say to her, we've got to assume we'll do half as well. If we do half as well, which is the long-term average of the S&P 500 over the last 15 years anyway, that means we double our money, not in 2.5 years, but in 5 years. I think we can live with that. Okay, we can live with that. That's not what you look for. Can't guarantee that anyway, as I have to tell my wife. Never mind you guys. That's the number which causes panic. So when you're putting these permutations together to create a portfolio, you want to make sure that that is something where you don't panic. Think about your house price. The best way to avoid panic is to know that you're going to be in your house for the next 5 to 10 years, or 3 to 5 to 10 years, and don't keep bloody looking at it every single day, as Warren Buffett's often said. That's it. It's a really simple process. It's a really simple process. I tell my wife, I can't guarantee the positive side, but I can guarantee the negative. That's what I told her on our wedding night. Works a treat, manages expectations. So how do we do it? This is what you do. This is what you do. Now, however you're going to do it, and I'm going to give you some stocks that I've done it with, that I happen to own, and some more in a moment, but I look at it at the portfolio level. How do you do it? If you're going to do it yourself, you better have something to measure valuation, because we know that's what moves stock prices from the academic literature. If you want to know the academic literature, I've put a ton of the educational stuff on alpeshpatel.com. Okay, valuation, price earnings ratios, price earnings growth, they'll do. Growth, you want sales growth or revenue, that's the same thing, or earnings or profits, that's the same thing, growth or cash flow. Why? Because companies only have 3 sets of accounts, profit and loss, balance sheet, and cash flow statement. So you better look at all 3 of them. But guess what? Valuation tends to be more important than growth, which tends to be more important than income. And momentum, since, when did I write Trading Online? For the last 25 years has become one of the most important, which is why there's been a massive growth in momentum-based hedge funds. It's become more important than these 3. And it's the thing people often neglect because they think, well, they don't understand it and they poo-poo it. Statistics I'll come to in a second. So when we get all of those together, I need all of these things to be green, these first 5 columns. And they very rarely are with British companies, not least because there's only 100 British companies, which are the 100 largest. By the time you get to the FTSE 250, the next 250, I'm sorry, there's nothing I want from there either. Again, I don't want my clients having a heart attack saying, why are you showing that? Oh my God, it should be confidential to us, because they will know full well I don't own any of these bloody companies. For a simple reason, there's too many holes. Look at the holes. The holes are the things in white. Okay, I'm sorry. If I need to get 10,000 companies in order to purify my portfolio and make it pure enough to feed my son and get 200 companies which meet, and out of that 200 be able to build a model which suits his appetite or his mum's appetite, which is that lower drawdown. His appetite's a little bigger, but his mum's appetite, which is that, because she's very risk averse. You need 10,000. You can't take freaking 100 UK companies. You might as well be gambling. There's not enough. I don't care that they're British. Like I said, I'm not racist toward the British. Or nationalist, I guess it's the word. It's just that, I'm sorry, there's just not enough in there to build with. If you can't get the building blocks right, then you're screwed. And IFA and St. James's Place are never going to tell you that. Because why? Well, because they've got a bloody British fund to sell you. Salesmen. Commissions, money to be earned. So there's your take a photo of this if you wish. That's your due diligence checklist. Take a photo. We'll return to it. How do we do it? Here's the other way. It's really simple. Okay. This. Harry Markowitz got the Nobel Prize in Economics for this. Well, not a bit more than this, but pretty much this. If you've got 2 investments moving countercyclically, i.e. both are risky, risk means volatility, both are volatile, move up and down. If you combine them both, you can reduce the risk and get the same return. There it is on an image. Think about it for a second. It's bloody difficult and counterintuitive. If you worked it out, you too would get the Nobel Prize in Economics. You and I didn't work that out any more than I've watched 100 apples fall, but it never occurred to me. I wonder if there's a gravitational force we shall call gravity. Nobel Prize economics. So that's all we're doing, is we're looking, once we've got these companies, is the correlations to see if they're inversely, but effectively uncorrelated, because then guess what it'll do? That will get reduced and that will still stay high. So all we're trying to do by putting all those numbers together, that's it. That's making money in a nutshell. That's what it's about. That's what it's about. What you think it's about is, do I put it on black or red at Las Vegas, Alpesh? One company or the other. Here's another thing, how we do it. Croaky, cash return on capital invested. Goldman Sachs, this is from their research, which hedge fund managers like me, we're lucky we get access to stuff like this because they want our capital, so they have to show a bit of leg of what they do. So we give them our capital, or in my case, use it myself. 30% CAGR, i.e. annualized returns. If your company, listed company, is in the top 25% by cash return on capital invested. What do I mean by cash return on capital invested? The amount of cash their capital investments have made. What's a capital investment? Imagine you made a machine which makes money and it produces cash. That's cash return on capital invested. Imagine you call that money a restaurant chain. That's your investment, capital investment. The cash coming out is the customer buying your stuff. It can be NVIDIA chipsets. Okay, it could be Chipotle restaurants, McDonald's restaurants. Capital investment is the factory, plant, and machinery. Cash is the money coming from sales. Okay, one over the other. The ones which have in the top 25% generally have done 30% per annum. What happened in this period, this crash period? Nobody did it. It's not guaranteed. It's not a bank account. It's a generalized rule. All rules in finance are generalized. They're never guaranteed. I'll give you another generalized rule. Undervalued companies tend to perform better than overvalued ones. It's not guaranteed. If it was, we'd all be rich. It's a generalized rule. There are certain general rules you want to follow. Sometimes they don't work, but when they don't work, it's only for a short period of time they don't work. Okay? Why do we do it? Well, to state the bloody obvious. So that's my son when he was 0, and I've been doing these webinars since he was born, actually before. So we opened a junior ISA. These would be the capital contributions. This isn't how his account's grown, because what's happened since he was born and now he's 7 is there was 2022, which was 4 years in, where it was 0. So that went sideways at that time. And then there was 2023, where it went higher, and 2024, where thanks to whatever, the gods of the markets went higher, and this year. So it's actually been, I'm not saying it's at this level, it's not. Sorry, it was higher. Now, there'll be times when it will go below and then higher and then up. So you might get this, you might get that, you might get this, you might get that. The point is, by the time he goes to university, or does his A-levels rather, if that's a thing back then, he'll have $500,000 in his ISA or more. Lucky git. But that's why we do it. Here's another reason we do it. This is a free tool. Go to alpeshpatel.com. I've got this free calculator tool for you to play with. It can rate your pension. So we had this as a query, and we were getting these queries. A lot of people said, can you rate my pension? Can you just let me know? So we thought, well, why don't we create a free app? Well, why don't we create an app and let's make it free? Okay. Just as I'm giving the book away for free. Again, go to alpeshpatel.com. You can get it for free. Now, so somebody was asking us, and they were essentially getting about 7%. And you can put in your own pension and details, and it'll give you a grade. So we looked at one of ours, which isn't guaranteed to do that in the future. So I know it's sort of, we looked at what ours had done over the same period historically. Now theirs might suddenly go through the roof and ours might suddenly collapse. Who knows? And what we discovered, and we took 100,000 of theirs. I don't think they told us how much they had in their pension. I can't remember, but we said, look, 100,000. So over the same 7-year period where they were essentially getting that, and we were getting that per annum, and they were getting that per annum, their result becomes that, ours becomes that, 672,000. Now, there's no guarantee from tomorrow morning ours will continue at this rate of growth. But the point being that meant they got a D rating. Now, this might not be suitable for them, but it certainly will give them a reason to pull their bloody finger out and stop accepting that, and whatever they decide to do. Okay. The idea being that at least it's a slap in the bloody face to say, look, this is what you're missing out on. Never mind us. You're just getting piss poor performance for what you want. And they wanted, by the way, they wanted growth. I think it was somebody in their 40s. So they were really looking for growth. Okay. And the IFA was just refusing to give it. The IFA said, no, you can't, you don't want this tech stuff and you don't want this American stuff. Oh, it's so volatile. No, stick to British companies. You live here. There might be a currency risk of 1 or 2%. So leave the 30% gains instead. This is another reason why we do it. Take a picture of this. Let's say you've got $250,000 portfolio. Now, I know a lot of people don't. So don't worry. Maybe you've got 10% of that. Maybe you've got 25,000. Maybe in 10 years, you'll have 25,000. Maybe you've got 2.5 million, whatever it is. So you've got $250,000. This is one of the reasons why we do it. Okay. I'll just end that poll. Underperformance, 68%. Well, most of you said it's underperformance. So let's say instead of 7%, you just got a 5% improvement and you move to 12% annually. Let's just say. Okay. Well, over 10 years, your portfolio goes from $250,000 to 776,000. You've gained another $250,000. Let's say you got a 10% improvement because you could tap into what's happening at the moment. There's no guarantees what the world's going to look like. Putin might put an end to the world tomorrow morning. Okay. Total return 17% annually. No guarantees of that at all. That's where you end up. That's your gain. My point with this is this. That can become ridiculously large based upon growth. Growth is good because it's magical. Growth is somebody else doing the work. If you have to save more or work more years to get to your end goal, then it's you doing the work, you making the sacrifices. If you can get the growth companies to do the work for you, then it's Satya Nadella, the CEO of Microsoft, doing the work. Okay. And that's a hell of a lot easier in life, having somebody else work for you than doing the work yourself. We're British. We like to work harder ourselves for a pittance. So you might not want this. You might say, don't want extra money. But how disgusting to talk about extra cash. Okay. But growth is the major problem. And IFAs won't do it because they've been charged by the regulator to say 7% is aggressive growth. Well, it is by bloody British standards in 1960, but it's not what's going on in the frickin' world. But the regulator's a bit slow. So the regulator said, you're in that 7%. It's actually good that they say that because you don't want little old grandmas thinking, where's my 30%? It's suitable for people who want growth and understand volatility, not everybody. So the regulator said 7%. So the IFA said, oh, shit, let's make that a target. Let's just deliver 7% because then we can keep the client for longer. Because if that client gets 30%, retires early, shit, they're going to go spend their money and we're not going to have them as a client. Let's instead give them 7, keep them on the drip in the ICU unit and their pension in intensive care for longer because we can keep bleeding them dry for more money. What about risk, Alpesh? Here's probably the easiest way to mitigate risk. Just hold more cash. Fixed income, I mean cash. This is from Goldman Sachs Wealth Management. Okay. It's not particularly controversial, so it's been in my books as well. There you go, Goldman Sachs Asset Management, Goldman Sachs Wealth Management. I think this is too conservative. The idea being years to retirement and equities. Now, I've got 90% of my money in equities because my wife says I've got 25 years to retire and I'm 54. So that's why I'm saying I think this is a bit conservative. You can always ease off, albeit in 2022, I had 0 in equities. But some people might prefer this. So I'm sharing it with you because you might say, no, I want to be conservative. I think if you want to be conservative, this is a good general rule, not individual advice, just general rule from Goldman Sachs Wealth Management. Okay, so the best way to mitigate risk is hold more cash. Let's say you had that portfolio, that model portfolio with 10% drawdown, and you said, well, I feel that's too risky. Fine. 50% cash, 50% in that. Now your drawdown overall on your portfolio is only 5%. 5% drawdown. Your return isn't 30% on all your capital. It's now 15%. So you double your money in 5 years. And it's only a 5% drawdown because the rest is in bank account. There you go. You just mitigate your risk, albeit you behaved more like a retiree, which you might be happy with, or a 65-year-old. Or what is the retirement age now? I'm not sure. Is it 67 now? Or for men? I don't even know the gender split. But anyway, I plan to work until Warren Buffett retires. So a long time yet. This is a conventional one, I think, from JP Morgan. I think it's too conservative. The reason you're not growing is because IFAs will use this and they will shove you into this, which you might say, wait a minute, they're going to shove me into that, which is 3 to 5 years to retirement. Okay. Even if you've got 25 years to retirement, they'll very often shove you here. If you've got 15 years to retirement, they'll shove you there. Maybe you've got 10 years, they'll still freaking shove you there. 7 to 10 years, they'll shove you there. 5 to 7 years, they'll shove you there. Most people won't get the bespoke, well, wait a minute, but Alpesh, I've got a bigger pension. I don't need to be in conservative, i.e. conservative means 30% in stocks and the rest in cash. But they'll shove you in it. Now, for some people, that might be appropriate. They might be very risk averse, and that's fine. But it's not one size fits all is the point I'm making. And your IFAs will shove you in the least conservative. Why? Sorry, the most conservative. Why? Less likely they're going to get into trouble and the longer they can keep you on fees. All the free tools, these are all free. Pension calculator, rate your pension, all of this. I'm going to come to the stock market bit in just a second. They're all free. They're all at alpeshpatel.com. All right. They are all completely free. Are you all there? Nobody's put a single comment in, which is incredible. As well, which is fine. Please do put some comments in, say that I know you're here. Maybe you're just absolutely gobsmacked. All of these are free. Rate your pension tool, pension calculator. I pay my team create them, and you don't get charged anything. And they're going to be free for life. You don't even need to enter your email address. Okay. So have a look at those at alpeshpatel.com. And they'll show you what I've just shown you. This is the problem. You've been told 5% is success, and I'm fed up of it. I'm absolutely fed up with it because I see Goldman Sachs going up 50% in a year. You tell me, is that some dodgy, hyperactive tech company? And your IFL say, no, don't worry, you've got it. You've got a bit of it. I'll put 0.05%. If they've got anything in their portfolio with less than 1% of your money in it, it's sitting there earning them fees and doing nothing for you. And it is why, as Eugene Famer pointed out, 91% of UK pension funds underperform a tracker. I want to outperform a tracker because I'm greedy. Okay. And high fees are one key reason, but also all the reasons I've mentioned. You know all of this. Feel free to take a picture of that. Okay. Also free. All of this is free. I've got 283,000 subscribers now on YouTube. So if you want more of this, of what I've said in bite size, Fix Your Pension Now. That's all on YouTube as well. So have a look on my YouTube and join, 5.4 million views on there. Okay. And TikTok, you'll see my daily stock market update. Don't worry, there's loads more to 1.8 million likes and 454,000 followers. Okay. So let's go on with some of the market stuff on this. So I've probably done too much. Thank you, Ravi, my friend. Really, really appreciate your comment. You put it privately. I'm going to share that. I'll broadcast the comment to the room. Thank you very much. So 2026, Morgan Stanley think, despite everything on there, and you can read this as I'm speaking because I won't take you through all of it, is they think for a variety of reasons, it'll be a good year. I think they said 16% up on the S&P 500 somewhere as well. They see global economic output, and partly because they think it's a rare combination of the Goldilocks effect. The economies are growing, but not too fast and not too slow. And they've put the numbers there. They've looked at China, Japan, Euro area, United States, and I agree with their analysis on this. But even were the market to fall, I'll just use the daddy bear rule if I need to get out. Now you can see it. Well, wait a minute, Alpesh. What about Japan? Well, they've given the numbers. What about getting a China ETF or a Japan ETF? Well, I've shown you the dangers and the alternatives. So I still prefer the individual stocks to a country-specific one. The only country-specific one I have is the S&P 500 and the NASDAQ, and I have leverage on those to get more return because, as I mentioned, ETFs, index trackers, tend not to give great country-specific ones great returns, albeit the S&P has given returns like it was a bloody stock with over 20% over the last few years. But when you leverage it 2 times, that's 40%, which satisfies my greed gene because now's the time to make money. Next year, there might not be, or the year after, in which case, I'll be glad I did it this year. Okay? So you can take a picture of that, but they've looked into, and we've looked into all of this, and these are the growth, the capital expenditure, US consumer and AI capital expenditure. That's what's driving growth. Okay, so I'm fine with it. Now, like I said, even if it falls, then I'll go into cash like in 2022 I had to, if it's a worst case scenario. So let's call this the best case scenario. Best case scenario, we fill our boots, make a load for our pension again. Worst case scenario, 2022. I've got a plan for both. I'm relaxed. I'm happy. I'm okay. Here's another way of looking at it and where the money's coming from and where, okay, there are some negatives. There are some negatives out there. Okay. Tariffs, government debt, power. However, that's the complexity. This is my version of what we think, and it's based on what Goldman Sachs research. I have a team of about 10, but they're not as big as Goldman Sachs or Morgan Stanley's teams or JP Morgan's. So what we do is we take all their information, we look at what makes sense to us and what we agree with, and if we disagree with something, we leave it, and then I've put it into an image, or my team's put it into an image for you. Very simple. The negatives and the positives, and I think we're okay for another year. But more importantly, if the market falls, we'll do what we did in 2022. Again, take a picture of this if you wish. This is more detailed of what I've just shown you. Okay. Yes, there's a complex background. What about, have you thought about tariffs? Have you considered the big companies which make up all the market cap? Have you considered the $100 trillion of global government debt? Have you considered persistent geopolitical risk? Yes, we've considered all those, and we've weighed it with what we've got elsewhere and some of the long-term mega trends. And the conclusion we've come to is if we keep picking good bottom-up companies, which are not these. So I will continue holding, and this is in the public domain, so it's not confidential to my clients, but I will continue holding my Meta, Microsoft, Apple, Amazon, Alphabet, Nvidia, and I'll continue having 2 times leverage in them, as well as all the other companies that I hold, which includes JP Morgan and Goldman Sachs, you should be aware of. And the fact that Broadcom fell yesterday 5% neither worries me nor there for the reasons that I've already told you. And when you look at the fact that $24.5 trillion is the total top 10 US companies, which is a shade below the size of the American economy. Well, if you were that big, what do you, and it puts everybody else into shade. So who's going to win this game of outspend? Who do you think is going to win it? The one with the biggest gun. There's no point in going, if this is a gunfight, if making profits amongst companies is a gunfight, I'm not going to go with a country which is bringing a knife to a bloody gunfight. The Americans are bringing guns, cannons, and the rest of the world are bringing knives. So, yeah. And it's not, I don't pick country first. I pick company first. It just so happens a lot of them happen to be American. So be it. They don't have to be. And this is where some of the money's coming from. Okay? Won't come as a surprise to you, but it's where some of the money's coming from. In case you're wondering, well, what's happening? NATO for a start. Whoa, have they got a lot of catching up to do. Now, this is incredibly important, and take a note of this, because the markets can only do one of two things. They go up, in which case everybody's calm, but more importantly, what are you going to do when it falls? You're either going to take path A, B, or C. Retail clients take path A, which is why retail clients don't make money. My clients will take path B or path C, and that's it. Either they will exit in the hope of buying back cheaper later, with the risk they'll buy back more expensive, or they'll sit through it, or they'll do 50-50. What they won't do is path A. What they won't do is path A, because I'm hand-holding them to make sure they don't. I am their psychiatrist, mentor, minister, priest, lawyer, mentor. I said that. Where are we at the moment, the S&P 500? So earlier this year, I drew this, and it's becoming incredibly popular. It's actually something which has been in my books before, okay? And I've done it when I used to do my Bloomberg TV show as well. Where are we? I'll tell you where we are. At the moment, we are still at 0.1, rising but overbought MACD, which is measure of short and medium-term prices. The risk averse would be cautious or stay out. The risk neutral would add to winners cautiously. Risk loving will buy because they buy all the time. 70% chance of a 10% drop in 6 months. Alpesh Patel said it first. You heard it here first. There's a 70% chance of a 10% drop or more in less than 6 months. We're at 0.1. Show me we're at 0.1, Alpesh. Show me we're at 0.1. Take a picture of that if you wish. Because this is today. That's where we are. Bang up to date. That's 0.1. Rising MACD. We're at 0.1. And I told you what happens at 0.1. What comes after 0.1, Alpesh? You're not going to believe this. My son's 7, and he got the maths prize, because even he knows after 1 comes 2. Well, that flattens. The risk is increasing, risk averse, and risk neutral start exiting, risk loving ignore. But we're not there yet. We're also not at 3, 4, 5, or 6. So don't behave as if we are. Behave as if we're at 0.1. We are at 1. And I told you what we do at 1. Simple. Got a plan. Deal with it. In fact, I say to my clients, print that out, put it on your wall. It's art. These are some of the earnings coming out. Any of these miss their earnings, and yes, I happen to own, any of them miss their earnings or an indication of it, they will dip. But that, if they dip far enough, it's an opportunity for me to buy more because they're of a quality that I would want to buy more. But if they dip, I won't panic. I'll be happy. Pick some more up. All right. That's the past week. All noise. 1 week is noise. A week is not a long time in investing. It might be in politics, but investing, it's not. It's a very short time. So the fact that Broadcom is up that and Palantir is only up that, couldn't care less. The fact that a journalist will write about sector rotation into farm and heavy machinery and Caterpillar, seriously, who cares? Okay, or Visa up. That's breathless headlines for journalists. Now you can read journalism the way it was meant to be read, with half a brain, because you don't need the other half. Past year, incredible that if you had asked me at the start of the year, which will move most between your holdings, Alpesh, in Microsoft, Nvidia, and Goldman Sachs, I would have got it exactly wrong. Because I would have said to you, Nvidia is going to move the most, then Microsoft, then Goldman Sachs. In fact, the correct order, it turns out, is Goldman Sachs up 53%, Nvidia 30%, and Microsoft only 8%. So I got it up exactly wrong. Alpesh, I thought you were supposed to be clever. No, as I keep trying to tell people, nope. I'm clever in that I know I'm not clever. That's actually the cleverest thing about me. And I learned that from a young age. Don't get me wrong, I got all the prizes at school and everything else, but my point is, I knew my limitations. And therefore, I thought, you're not going to make it in modeling. You're not going to get a Nobel Prize. You might just want to buy shares in other people's companies and let the clever ones build the companies and you ride their coattails. And then this other bloke, Warren Buffett, was doing the same. And I thought, sounds a good idea. Okay. That's why we have a portfolio and not individual stocks. I'm trying to reprogram your thinking. Your thinking is, by how much is it going to go up? How quickly? That's newsletter territory. That's gambling territory. Feel free to go on social media and gamble or Vegas. I mean, don't do it. ETFs, I'll do a separate one on the exchange traded funds. You can see gold is still well. Don't do leverage. You don't know what you're doing. Don't do it. It'll blow your pension. Don't have leverage in your pension. You don't know what you're doing. Crypto, look at that. That's taking a bit of a hike. If you don't know crypto is volatile, you're insane. Now, I happen to own a tiny bit of Bitcoin. God knows where and how much. But if it goes down to $50,000, I might buy some more. Until then, it was for fun. My wife bought some art a couple of weeks ago, and I did it with the same intent, for fun. Some bloke had been to the Louvre and said, I've got some art to sell you anyway. I said, okay, it's for fun, but not for resale within a week. Same with crypto. It's the same as art. Might be worth nothing, might be worth something in a few years. But if you don't enjoy holding it, then don't bloody buy it. Markets over the past year, very unusual for the UK to get over 20%. Every time it's done that since the Second World War, I think I'm right in saying the next year it's got single digits. And I think in the last 20 years, there's never been 2 consecutive years where the UK market has outperformed the US. So we'll see, but I think the Americans might do better than the Brits next year. Doesn't mean you shouldn't have it. I mean, those are amazing numbers. I didn't create those returns for my pension over the last 3 years. The tailwind in the markets did. I never thought they were going to be this amazing. I've been around for a long time. These are unusual numbers. And we had that in 2024 and in 2022. And it looked, 2023, 2024, and 2025. And it looks like potentially we're getting 2026. So yeah, it might be those 4 years, 3, 4, 5, and 2026, those 4 years. And basically what I thought I was going to earn over the next 15 years has already been done in 4 years. And hey, take that out, put it somewhere safe. Everything else is just playing with profits. Who knows? Whatever it is, the point is, it's not me. I didn't make that happen. In fact, the sum total of what I did was nothing. That's investing for you. Okay, Broadcom, Micron, Visa, Goldman's, Palantir, just showing you some of the names, how they've done. I mean, these are ridiculous numbers, but they scare the bejesus out of St. James's Place in your IFA because of the volatility. But if you pick a portfolio where some are uncorrelated or counter-cyclical, then guess what? You reduce your drawdowns, and that's what matters, the portfolio level. But don't sacrifice growth in return for it, okay? Which is what most people do. I'll do a separate one for UK generally. NASDAQ, it's at 1. Same, I showed you the chart already. NASDAQ is at 1, just like the others. What time periods are we using moving average in the short, medium term? For the MACD, the charts are weekly. Look, you can tell. See that? If you want to replicate my charts, that's weekly. Okay. You can use TrendSpider, Yahoo Charts, or TradingView. And the MACD is a month, weekly, which is based on that. And then there's a monthly one. You can ignore the weekly one. It's the monthly, and the timeframes are the default ones. As I've mentioned in my books, the reason I use the default ones is if you ever change those average prices, then all that happens is it's never 100% correct. All that happens is it's still only 70 to 80% correct, but just on different periods. It doesn't make a difference. So I just go with the default. FTSE 100, very, very unusual. Normally, when these average prices peak, as you can see here, they drop, price drops, price drops. Okay, you normally get this dip. Except once in 6 or 7 times, it can blow the roof off. Now, this is happening a lot with American companies. Very unusual to happen with British companies and the British index, but it's happening at the moment with this, and so it's skyrocketed. How long will it last? I honestly do not know. I don't know. Long may it last. And British companies become bigger and bigger and richer, and more people think about investing. Even Martin Lewis, who hates investing and thinks it's gambling and only believes in saving money, covered it on his show, the Martin Lewis show. I've met him once and once he was on Twitter and he said investing is like putting your money on the 240 at Kempton. I thought, okay, maybe the way you do it, having sold your company for 60 million, it's interesting that you don't think other people should benefit from shares. Fine. And then I met him about 25 years ago before he was quite famous, and obnoxious individual, arrogant as hell. And that's when he hadn't made all his success. Anyway, separately, FTSE 100 could keep going higher and higher. Leveraged 2 times S&P. Don't do this. And certainly don't do it in a pension. I do it because I'm very, very old and experienced. That's still rising, so I'm okay. The reason nobody else should do it is this. That's 2000, well, that's 25, and that goes as low as 15. From 25 to 15 in the space of, which is nearly 50%. So you lose 40%. You lose 40% in the space of 2 months. That's why you shouldn't do leverage. And that's why people like me start getting worried and taking money out as soon as that starts dipping, sometimes as soon as that does. So at the moment, I'm still in, but I'm happy with that. Microsoft, I really should be looking at whether I exit or not, because when it's happened before, so it can go from there to, poof, this could easily go, poof, okay? And that's what I want to avoid. So I'm on sort of DEFCON 1 with that, because it's the leverage version. The underlying, I'd probably buy more of Microsoft if it collapses. But leverage, no. Leverage, I don't do that. I don't buy more bloody leverage if it falls. I don't have those kahunas. Okay. What else have we got? Key statistics in order to establish what stocks are best, including data like discount cash flow. I think Simply Wall Street's very good. Charlotte, you've just hit the nail on the head. You know, but discount cash flow, Charlotte. Now, this is where the problem occurs. A little knowledge is a dangerous thing. The academic literature shows discount cash flow is not a very good metric for stock price impact. In other words, what moves stock prices is the question you're asking, and where can you get the data for it? Valuation does, and discount cash flow is not a good measure. P is a better measure historically. Revenue growth is more important than even valuations. And momentum is the most important of all. So what you're going to see on Simply Wall Street, because they want to sell you a subscription, which is fine, is every single metric. But what you need to know is which of these are important and which aren't. Okay. Bitcoin, again, it's an exchange trade against the US dollar. That the danger is it's going to do this. If it does do that, my long-term holdings, I'm not going to sell with a view to buy back later. What I'll do is I'll probably start buying as soon as this flattens. So I do hope it collapses, and I hope Bitcoin collapses to around that level. I'll see. I don't know how much it's going to collapse. I don't try and overpredict, but I hope it does, because then I'll start buying more as soon as this flattens, which could be as little as, I don't know, it might drop to 22 for all I know. It might not drop at all. It might just start rising again, in which case the holdings I've got are all that I'll have, and I won't have bought any more at a cheaper price. Oh, well. That train left the platform, so be it. I can't fantasize what might happen. That's like fantasizing I win the lottery. Apple, I'm still holding on. It's overbought. But this is why I've got Apple. This is why I do leverage on Apple. Because Apple generally, when you look at the statistical analysis of it and its return histograms, will cause people to panic, because very few rare times it can drop 24% in 5 days. However, it has a history of generating positive returns over a year. So it's a classic buy the dip, because that isn't too low as a percentage. You don't lose too much and don't scare yourself too much. Tends to be positively skewed, i.e. more returns than losses, and tends to have lower losses as the days increase. That's what buy the dip implies. And yeah, we're going to buy the dip. They haven't thought through what that means. It should only happen in companies with those characteristics. Apple's one of them. There's probably only about 7 or 8 companies in the world which are them, and I own them. Don't worry, you can buy some of them as well. And I mentioned them already in this webinar. Advanced Micro. Okay, this is just to show you why you should think portfolio, not individual stock. If you thought Advanced Micro at the individual level, and let's say you go, I went on Alpesh webinar, I bought Advanced Micro, and then over the next year this happens, and it could, and you say to yourself, that Alpesh is an absolute bloody idiot, because I've just lost 75% of my money, and then doubtless you would panic and exit there. Whereas if I'm looking at it as part of my model portfolio of 30 other companies I have, and I've only got 30th of my money in there, first of all, I never panic for that reason. And secondly, because I'm looking at it over 2 to 3 years, I think, well, it didn't quite work out as well as I thought it would, but it still had a dampening effect on the others, and it's fine in the portfolio. There's a difference. And most probably I'd end up buying more of it anyway as it fell. Okay. Now, is it a buy the dip one? You can see the difference between that and Apple, can't you? Most are more like this. Or a WR Beckley keeps going up and up and up. I'm fine with it. But what if it should break below this? Well, my first thought would be, when do I buy more? My second thought would be, I'm not worried, because it's 1/30th or 33rd of what my wife owns. So why worry? Whereas people looking at the stock level will absolutely panic after 5 days because of a 15% drop. Because they're looking at the stock level, not the portfolio level, and not the time frame level. Because to begin with, they had a gambling stock anyway. This is the S&P 500, only up to last week, but it doesn't matter. It's not changed much. And you can see that's where the S&P has gone to. And these companies, the larger the company, the more it moves the S&P. These are underperforming the S&P. Oh, but you didn't beat the S&P, and you said Microsoft. Yeah, that's exactly correct. But I did, because all the others that we have were big enough. And this year it happened to be bloody Google and Goldman Sachs. I didn't know that at the start of the year. I could do a fun game at the start of this year and say, which stock do I think is going to be the best performer? Why would I do that when I'm thinking portfolio level? Because I don't know which one's going to be the best performer. Last year, I would have thought it was Nvidia, and it's not. With bloody Goldman Sachs, which I'll be honest with you, I did not think was going to be the best one in my portfolio. I thought it was going to just give me a steady 20%. So if everything went tits up, at least I had the stability and safety. That's why it was in there. And it ticked all our boxes: value, growth, income, cash flow, Sortino. That was why. If you're interested, this is what Warren Buffett earns. He and I would probably both do the same thing, is go through all of this. You can take a picture if you wish, but don't go and buy stuff just because he's bought it or because Bill Gates or Goldman Sachs own it. That's not a reason to own these things. That'd be a stupid reason to own it. Panic and boredom is what will kill you anyway. unless you've listened to this webinar closely and everything that I've taught you. Like I said, the way we do it is that gets converted into that, and based on each individual's that. We get some people who are very scaredy cat and they want that to be 10%. Get others who are like, mate, been doing this old hand, don't worry. Or they're very rich and they just put a small proportion in managing their own portfolios, and they do that instead. So what is it? You take those, and it's very important. Don't give your money to somebody else to manage. Don't now think, Alpesh, can you manage my money for me? No, thank you. I've got a stressful enough life. I don't want to manage your money. Okay, I want you to manage your money. That's the whole point of writing all of these and doing these webinars, that you take control and you manage your own money, and IFAs don't F you up. That's de-risking through non-correlation. That's the other thing. That's the hand-holding to make sure that you don't try and time the market, but you don't panic and you don't get bored. Panic and boredom, they're the things that kill you. And the other thing is diversification. Basically, after 40 stocks, it's a bit of a waste of time. Okay? You might do it for psychological reasons, but the sweet spot's really between 20 and 40 statistically. Guess what the average fund manager has? Over 100 stocks. Over 100 stocks, they've got so much money to deploy. All they're doing is making your performance worse and not reducing volatility and risk. Here's something else which is worrying. Over the long term, and I took a 5-year period, not the last 5 years, because if I took the last 5 years, you might say, well, you only took the last 5 years, that's just now. No, I took the 5 years before that. And it's typical. This is where the poverty gap happens. Your IFA, St. James's Place, Fisher are all trying to shove you into UK, and that's fine. Except that's what's going to happen. You're not going to believe this. A version of this was on Martin Lewis's show on ITV. I don't know if anybody saw it. Exact version of this. Somebody from his team's been looking. Okay. And that's the point. You better have that global exposure, because that's what's happening. Unfortunately, most people are wired to fail. They panic at that point and they buy high and they sell low. So part of the job is psychology. It is psychology. Part of the problem is most people don't know this stuff, because guess what? They don't read the books. I've done 18 of these. Oh, there you go. Don't buy them. alpeshpatel.com. You can download some of them for free. Financial Times are my publishers. Wiley are, Palgrave Macmillan are. So this is not self-published, okay? Don't listen to journalists. Brokers, even worse. Fund managers, bloody terrible. Banks, yeah, except you're not going to get access to them. Word of mouth, go to the pub if you wish. Gurus, well, simple. I just gave you their portfolio, but he bought Coca-Cola in 1950 and he's living off the dividend, so that's different. Everything I've told you today, I have written about, not just in the books, but in the Financial Times. The point being, it's peer-reviewed, and it's not just I woke up one morning. I mean, there you go. Forget such market headlines as 10 stocks you must buy now. Okay. And I think you can be better than fund managers. That's my whole point. I mouthed off about it so much that the FT did a competition. So, well, if you think you can be better than fund managers, why don't you do it yourself? All right, then. And then beat that fund manager who came in 14th. And that was in the early time. Bloomberg, Channel 4 did a competition as well with stockbrokers and all the rest of it. Now, doubtless, I'm sure I couldn't repeat it every single year. Okay, I could. And the problem is, people like him, they just don't know what the hell they're doing. You've got a whole load of free insights of mine on my YouTube channel. Again, 283,000 subscribers, 5 million views. alpeshpatel.com for that. If you want, look, 99% of people who are on my webinars, they love the free content, and I'm more than happy to give it. For those who want the hand-holding, want the data and the hard work done for them, which is what we do, and we give you this, and then me do the mentoring and show you how to do it and create the model portfolios with you so they suit you, and I have my team doing all the hard work behind the scenes, then you can join my program. My ambition is to get, well, it was initially 350, but I was talking to somebody today. I don't know whether it'll be 500, but anyway, the idea is to get to a certain critical mass and then have venture capital investment and then eventually float it as a company. And somebody said to me, why do you want to float it? And I said, do the maths. If you've got 20 million in profits and a multiple of 40, that's an 800 million valuation. That's how the stock market works. It works on multiples of profits. If you get profits of 1 million and you've got a 40 multiple because you're a tech AI company, then that's a 40 million valuation. Suddenly your 99% stock that you sold that you own is 39.5 million. Anyway, that's the idea behind the program. Proven process, research, hand-holding for life. We don't charge you. We have a model which is you don't get charged subscriptions or fees, because then we'd be no better than IFAs. It's a one-off, but you get lifetime hand-holding, lifetime access as well. There you go, expert mentoring and the hand-holding and everything else. Sarah, don't worry. It is a great program, but here's the good thing. Hi, Shashi. Here's the good thing. You've got all my free content anyway and teaching you bit by bit by bit. So you're still learning. I don't want it to be exclusive, which is why I do the free stuff as well, and give you free copies of the book and everything else. It's just for those who are time poor or business owners or got, 100, 200, 300,000 in their pension, thinking, you know what, I think I want to have somebody help me, like a plumber. I'm a glorified plumber. It's like that. And we don't want your capital. You're gonna put it with whichever broker you have, whether it's Barclays Stockbrokers, Free Trade, AJ Bell, Interactive Brokers, Interactive Investor, Hargreaves Lansdown, whoever you choose, you continue making your decisions. We're educational, informational. We're not managing or giving you advice that you should buy this. What we're saying is, here's the data, here's the portfolio which you said suits your risk profile. Does that look right to you? And teaching you how so you can learn to drive. And the idea is then you learn to drive. And that's my ambition. It's a different type of asset management company. So we still have the private equity fund and all of that, but this is the one which, who knows, might, if we float it on a multiple of 40. As I joked to the person I was speaking to earlier today, it's a teetotal vegetarian who hates driving. Money's not the motivator, because what the hell are you going to do with it when you're a teetotal vegetarian who doesn't know how to have fun? Right. Well, I think this is fun. Okay. So if you want to join, feel free. I would love to see you on there. I'm going to answer some questions as well. I will put the link up. I will also put up on there the copy of a book, the book you can download right now. Actually, I'll put that up there. Where's it gone? It will come up in just a second. There it is, Investing Unplugged. So you should be able to see the book as well and download that. That should hopefully come up on there, plus a whole load of other information. But at least the book will come up as well, I trust. Okay, and I'm going to show you. So that's the website. Sorry, I should have given the website. The reason I've removed the price is that's about to go up, because each year we look at the NASDAQ, the S&P, and the Dow, and we put the price up by the higher of the three of them. So this year, by January, it'll be up by between 20 to 25%. Why? Well, that's the stock market. We've got clients making, the rich end of clients making $1 million. The bottom end of clients who might only have 100 grand in their portfolios making 20 grand. So you can imagine putting it up a bit makes sense. Welcome to capitalism, I guess. So have a look at alpeshpatel.com/shares for that. That's the website, and I hope to have people on there. I will also stay on to answer your questions on this as well. That is all of it in a nutshell. Okay, all of it in a nutshell. And why what it does, I think, is it solves a major problem, and it's why I think we'll get all the investment we want if I want to give up any degree of control over it, then I think we'll get it. I'll come back to that in a second. I'm also on LinkedIn. There's 28,000 followers there. That's already gone up today. I looked earlier, and you can see a whole load of articles on there. So you can follow me on LinkedIn, where I'm a top voice apparently as well. This is Threadneedle. So we did an article. Again, you can see all my articles on alpeshpatel.com. Did an article on Threadneedle because it's quite popular, and how that's what they're targeting, which is really worrying, and what we're targeting and why they're targeting it. And the reason is they're not reducing drawdowns, which is what was shocking. Their drawdowns are not reduced, but their returns are reduced. So they're not reducing your volatility, as you can see here. You're still getting similar volatility to us, but you're getting significantly lower returns, which is nuts. And the reason is because they're spreading the money amongst 100 companies, not just 40, because they've got so much capital, because they're bloody Threadneedle. So they would have so much capital, wouldn't they? Is the reason why. Let me go into answering questions as well, and then let you all get on with your weekend chat on this. Alpesh, been running through your videos trying to find something specific you said about a while ago. Sortino and return alpha ratios. Remember, one should look above 1 for Sortino and the other 0.3. Can you educate me which was? Yeah, the thing about the Sortino is people get really fixated about it. Well, the Sortino, for those who don't know, it's one of the ratios we look at, and it's very important because what it measures is average return. Everybody understands average return. Okay, what they don't understand is volatility by how much you miss it. If you remember your maths, everybody understands the mean or average. They don't understand the standard deviation, which is the average of how the average of the misses of the average. So let's say you got, I don't know, runs in cricket. You got a 20, a 30, a 40, or 50, or 60. So I could tell you, yeah, your average is you average 30 runs a game. And you go, yeah, I get that. But the volatility of that is, yeah, but you're plus or minus, say 10 runs a game. You might, on average, you're hitting 30, but on average, you're also missing it by 10. That's the standard deviation, okay? So with stocks, the reason that's important is it's one thing for me to say, oh, my return is 50%. But what if that's because one year I got 1,000,000% return and every other year I've been down 99%? That'd be pretty shit. So what it's actually saying is, like a cricketer, you want somebody who consistently gets 50 or 100 a game, not somebody who might get a century or a duck. So what the Sortino is measuring is we want a high average, but a low deviation to the downside. Why? Well, because we want the kind of stocks which don't fall too deeply down. And if they do, they recover quickly, hence Sortino. But the past is not a guarantee of the future. So you want the Sortino to be above 1. Sadly, historic Sortinos and their correlation to the future are not as good as, say, growth or momentum metrics. Okay. Like the MACD, the moving average, is a measure of momentum. That tends to be a better predictor than does even the Sortino. But the Sortinos are nice to have and essential to have, so you want to tick that box. So above 1 is the short answer to that. And the alpha, to be honest, you could almost leave the alpha, but essentially, yeah, generally if it's above 3%, alpha is just about how much you say beating the market, to keep it in simple terms, beating the market. And you want to try and beat it by as big a number as possible, but just because you beat it historically doesn't mean you do it in future. So it's just a way of narrowing things down and saying, well, I want things which historically have tended to beat it by 3% or 4%, at least. And anything below that, well, I need to sift through these CVs of companies, so I might as well ignore them anyway. Do you see? Does that make sense? Hopefully that all makes sense. So yeah, you want that above there, but don't get fixated on the numbers, because what will happen is you'll try and fit to the data more than the data can carry. You'll think, oh, if I get all this data right, I'll just get best companies. No, that's why Warren Buffett and I have more than one stock. Because if we could do that with data, we'd just have one stock, wouldn't we? Okay, but we don't. It's why we have a portfolio of more companies. than that. Okay, thanks everyone. I've been on way too long. I've been on 90 minutes. I wanted to be on for an hour. So thank you all. If there's other questions, just email me. Okay, I'd really appreciate it if you emailed them across. So thank you, but I will leave it at that for now. And for those who've signed up, I will send you an onboarding email, and we'll have our first onboarding one-to-one call and give you access to the data and everything else. And then we'll have our onboarding call to teach you and access to the back-end education material as well coming up. Okay. Thanks, everyone. Indeed. Thank you.